This is a discussion of the Ford investment case. We'll be discussing Ford's recently announced second quarter results, including cash flow and credit metrics. We'll discuss consensus outlook, implied trading levels in terms of PE multiples, from which we will infer implied share price, and discuss the opportunity for investors. But before we dive in, just a kind of a philosophical point why I make these super deep dives, even in companies that may look on the surface quite boring, and where there appears to be very little or no news flow, causing a rally or sell-off to create long or short opportunities. The big picture is that if you study a company in depth and have a clear picture of where it used to trade in terms of valuation level, and have a clear picture of what the company can deliver in terms of earnings generation, you can react very quickly if there is breaking news. In fact, you can respond more quickly than even AI. I'll give you an example. If you ask AI, how would news so-and-so affect Ford's outlook over the next 12 months? If you try to run such a prompt on, for example, Grok 4, or even on Grok Heavy, that prompt would likely run for, a minute, two, maybe more. But when you study a company thoroughly and you see the news breaking and running running over the tickers, of course, the algorithm will already drive up the share price. And of course, super quick traders. And then you can make literally a split-second decision on whether or not to buy into this news item or sell the stock short. And to give you a specific example, just very recently, there was news about a partnership between Uber and Lucid. Lucid's share price rallied briefly over 40%. You heard it right, 40. And because I studied the company intensely and I created a very bullish outlook, I knew the opportunity space. The opportunity is how, if everything works out perfectly, how good could things be? And I knew that this massive spike of this rather mundane news item, this partnership, was actually a nothing burger. And that's why I could very quickly take action and take a short position, and ultimately could do several rinse repeats over a couple of days. So that is just a very recent example of how this system works. One, you study a company intensely, you know exactly where it can go, up and down, and then on both positive news and negative news that cause excessive buying or excessive sell-off, you can respond very quickly. So you get in either long or short, and you get out. Using this method helped me to beat the S&P 500 materially for, at this point, over 20 years straight. So with that out of the way, let's dive into this company, Ford Motor Company, ticker F, currently valued, and you can see it on the right-hand side of the screen, at $43 billion. Stock closed on today's Monday, on Friday, at $10.82. And the stock is down just under 5% over the last month. This is a stock in a company most retail investors will never spend any minute investigating, because most of them, at least in my perception, are all focused on latest AI trends, Bitcoin, and other opportunities. But the beauty of something like Ford is there's a lot of information that allows quite accurate forecasting, and it's simply a company that is stuck in a certain business model from which it can't break out, and this limits downside and upside risk, and depending on what view you take, limits your risk exposure. So to cut the long story short, Ford is, if you understand the company, a potential opportunity that as part as your overall portfolio mix you can use to generate some extra return on silly news items. There is one soon coming up. In exactly 1 week, Ford will present its latest EV technology that comes out of its skunk works. And when the news breaks, I will quickly assess, based on what I already learned about the company and what happens to the share price, whether it's a buying opportunity or a shorting opportunity. My current base case is it's highly unlikely, given the long and unfortunately miserable track record of this company, at least over the last couple of years. It's highly unlikely they will produce a killer product. My base case is more that they will produce something that is more in line with current competitors. My best guess at this point is it will be likely quite similar to the products that General Motors launched over the last 3 quarters. I might sound quite negative on the company, but I think the market agrees with me. And A quick way to check that is when you look at the implied multiple of Ford. At the moment, the company trades at 8.2 times forward earnings. This is not based on my estimates. This is based on consensus. And by the way, the slide you're looking at is the 1 year forward P multiple trend. But there's a bunch of detail to this. I recommend if you have not seen any of my other videos in which I explained this, pause the video now and read the comments on the right hand side of the slide. So the bottom line of this slide is to show you the trading level is quite low, so investors do not have a lot of confidence in the stock. Otherwise, they would be assigning a higher value to Ford's future earnings, and the multiple would be higher. So let's discuss what's really going on. So let's look first at total revenue. And by the way, just as orientation, here on the right hand side of the slide, you have the income statement of Ford. It shows you the key items. This is really just to provide some guidance so you don't get lost in the numbers. By looking at the right hand side, you always know what we're talking about. So total revenue looks good. Revenue is up 5% year on year. You see this here on this percent number. Total revenue came in at just under 5.2 billion. But there's already one cloud on the horizon. If you look at the first half, which is down here, revenue came in at 90.8 billion, also not that bad, but the year-on-year growth rate is only 0.3%. This already gives you some indication of what's going on, and you can also see it graphically. You can see that the first quarter was quite weak, and the second quarter saw quite a bit of a recovery. So this had to do with demand effects caused by tariffs and other things, and winter seasonality all mixed together. So we saw a lot of kind of headwinds in the first quarter, and then we had a lot of unwinds of these headwinds, and they turned into tailwinds in the second quarter. But the bottom line is really revenue didn't really grow year over year. And when it comes to revenue, always keep in mind you have only real growth in the company if revenue grows above the inflation rate, and this is not the case for Ford. So technically, when you look at the first half of 2025, Ford actually shrunk a little bit. So first point to remember, no revenue growth in this business, no real revenue growth in this business. So next, let's look at, okay, what is driving revenue in Ford? Ford has two main and very distinct segments. One is obviously the automotive segment that obviously captures the entire auto business, so sale of vehicles, part service, etc. But then there is Ford's financial arm, which is called Credit or Ford Credit. And this financing arm, Credit, bundles all of Ford's dealer financing and customer financing and all the leasing activities. This is quite common in the global automotive industry. All large automakers have this kind of setup. So let's look at the revenue. So Auto generated 47 billion in the second quarter. Credit generated 3.2 billion. Auto was up 5% year over year, and Credit was up 8% year over year. Here the point to notice, so the first half, Auto was down 0.4%, and Credit was up 10.1%. So Credit was even though it's, as you can see in these charts, they're on the same scale on purpose, is substantially smaller, but because it's growing quite significantly, it did help to offset at least partially the shrinkage in the auto business. But keep in mind, the credits business is driven by Ford's auto business. It takes care of all the financing of its vehicle sales. It's a captive finance provider, effectively. So this current situation that the credits business keeps growing quite significantly while the auto business is shrinking cannot go on forever, because ultimately the auto business feeds the credit business. So that's the second observation. Auto quite weak, credit is helping to offset, but it's unsustainable. So next we split the auto segment into its main three components. There are three segments. One is Blue, one is Pro, and one is Model E. Pro is sales to consumers. Blue is sales to consumers, ICE vehicles and hybrids. The Pro segment is to businesses, government, also comprising ICE and hybrid vehicles. And then the Model E segment is Ford's electric vehicle business, and this is mostly to consumers. So in terms of overall revenue contribution, the Blue, so the consumer segment, is the largest. It contributed just under 26 billion in the second quarter. The Pro segment contributed just under 19 billion, and the EV segment is still quite small. It's just 2.4 billion, but was growing quite substantially, was up 105% year over year. But there's a big problem I will discussing later with that. So the blue segment, so the consumer business, was down 3%, and the strong growth in the pro segment at 11% year over year did help to offset that decline. But please pay attention, the H1, as we discussed earlier, is not looking good in the auto business. It's down. And the reason is both the blue and the pro segment are down. Blue is down 3.4% and the pro segment 2.9%. EV business is up quite substantially in the first half, 185%. But this comes on a very low 2024 comp. Comp is comparable, so the H1 of 2024 is really low because there were some one-off effects that depressed the first quarter of 2024, which caused Ford to report revenue that was reduced due to certain rebates. But I discussed this before, and so I will not go into this topic here. So let's move on. Now we get to vehicle sales, and what you're looking at is a wholesale vehicle sales, or you can also call them dealership sales. So this is not where a customer went to a dealer, bought a vehicle and drove off. No, this is how many vehicles Ford delivered to dealerships and whether this vehicle sits on the dealer lot or not, and or is bought by customer, makes no difference to Ford's financials. As soon as the vehicle is being shipped from Ford's factory to the dealer, Ford books that vehicle as revenue and all associated accounting expenses with that vehicle. And again, even if this vehicle later ends up sitting on the dealer lot for a year, Ford already booked that revenue, etc., at time of shipment to the dealer. This is also standard practice in the global auto industry, with certain exceptions. And this already gives us a good indication what happened in the first quarter. First quarter was down 7% year on year, and then there was this strong sequential recovery, 22% up from Q1 to Q2, and driving a year-on-year increase of 4%. But keep in mind, the second quarter was likely, at least partially, a recovery from the first quarter from these one-off effects. So this 4% year-on-year growth rate is most likely overstated. And you can see how the first half of this year is still down 1.4%. Now we dive into the different vehicle segments, so Blue, Pro, and EVs again, to see where the vehicle loss actually occurred. And you can see that the vast majority of the loss in the first half actually occurred in the consumer segment, so the Blue segment. You can see how the first half was down 6.1% year over year, so that's quite a lot. Also, the Pro segment showed a little bit of weakness. It was down 0.4%. And then again, EVs up quite substantially, 153% in the first half. But again, this comes on a very low base. You can see last year in the first half, Ford only sold 36,000 EVs. This is, if you annualize that, it would be 72,000, which would be a really, really low sales rate. So the key takeaway is that the primary weakness appears to be emerging from the consumer segment, at least in terms of volume shipped to dealers. Again, we're talking about wholesale vehicle sales. This has nothing to do with how many vehicles are actually driven off by customers from the dealer lot. Of course, ultimately, the chickens have to come home to roost. And at some point, when the dealer lot is too full, there is a natural alignment of true underlying demand by consumers and how many vehicles Ford can ship. Next, we look at average vehicle revenue booked. So this comprises everything, how much Ford made from selling the vehicle, selling used vehicles, selling parts, accessories, providing services and various other things. And we can see that revenue is up year over year to $37,000. That's up 3%. But the Pro segment is down 3% year over year to $43,800. And this should give you pause. When you look at these revenue numbers, you can see that Ford makes a lot more in the Pro segment. So apparently these customers, so businesses and government, they buy much higher value vehicles. I talked about this before. I think what Ford does in certain areas, certain types of customers, especially government-related customers, Ford is, I think, overcharging for certain types of vehicles, for example, police vehicles or other government entities where basically the purchasing decision maker spends taxpayer money but not their own money. And we see later in the margin analysis that there was something going on here because margins were way too high. but they are coming down. But this is a topic we discuss in a bit. But then let's look at the EV segment, Model E. Revenue came down 11%. This was to be expected because Ford had to cut prices left and right. There was heavy discounting. And then, of course, the EV fleet is quite new and doesn't benefit from part sales, since as long as the vehicle is under warranty and something breaks, Ford replaces that part and doesn't generate any revenue from that. So next, let's look at the outcome of all of that. So now we look at total EBIT for the company. So EBIT stands for earnings before interest and tax. This is a very important metric since it tries to come up with an earnings estimate that is independent of the capital structure. So capital structure is how much debt a company is using, because it makes a big difference whether the company is like debt-free or has a ton of debt. And by looking at earnings before interest, so interest on debt, you can eliminate that factor. And also tax, because the interest comes with a tax shield effect, because the interest expense lowers your tax expense. There are other things to consider and why EBIT is so popular amongst investors, but that would be its own video. So let's look at Ford's EBIT development. So EBIT is down 22% year over year, is down 43% in the first half. In the second quarter, it came in at just over 2.1 billion, and for the first half, it came in at 3.2 billion. What's kind of remarkable about Ford's EBIT is the fact that over the last 3 full financial years, so this 2022, 2023, 2024, EBIT came in remarkably stable at 10.4 billion, 10.4 billion, and 10.2 billion. So for 2022, Ford guided for 11.5 to 12.5 billion in adjusted EBIT. So it ultimately delivered on an unadjusted basis 1.1 billion below the low end of the guided range. So that was 2022. Then after this significant miss, Ford was a little bit more cautious in the following year and then guided for 2023 for 9 to 11 billion in adjusted EBIT. And then they delivered EBIT of 10.4, so they were right in the middle of the guided range, or technically slightly above, because the middle would have been 10.0 billion. Then for 2024, they raised EBIT guidance to 10 to 12 billion. And finally delivered just over the lower end of the guided range at 10.2 billion. So what about this year, 2025? They took down guidance substantially and took it down to 7 to 8.5 billion. So we already know the first 6 months, it's 3.2 billion. So the midpoint of the guided range would be 7.8 billion. This means if we deduct from 7.8 billion what has already been delivered, 3.2 billion, we get to 4.6 billion. But there's a problem. The guidance I just told you for 2025 was the one at the beginning of the year. Then after all the tariff stuff, Ford took it down, and then they reinstated the full year guidance with the 2Q earnings release. And then Ford was guiding for full year 2025 for 6.5 to 7.5 billion. So the midpoint would be 7 billion. This means we have to deduct from 7 billion to 3.2. That gives us 3.8 billion. That is now the outlook as of end of July for the rest of the year. So not looking great. If Ford ends up in 2025 coming in at midpoint guided range, 7 billion, that implies a 31% drop year over year. And I think now it becomes quite clear why the stock has been trading for so long at such low multiples and currently only trades at 8.2 times. Even management doesn't expect a stellar second half of the year. And the year on year will be looking quite abysmal. And as you can tell probably from me walking you through the guidance and what was delivered, it's not like this management has a track record of sandbagging. In fact, they used to be too optimistic and only in the best of years slightly exceed the midpoint of their guided range. So let's move on from these absolute numbers, EBIT numbers, on a quarterly basis to sort of a long-term trend. And this is what you see on this slide. You can see the COVID impact that happened in the second quarter of 2020. The bottom line of this chart is really to show you this company has like a many years long track record of not performing well. And I'd like to point out there were some really strong years, especially after supply chain shortages reduced. In the 2022 era, a lot of auto companies did extremely well, extremely high margins due to shortages, etc. Very strong pricing power. And even during that period, earnings weren't really that amazing. But let's look at what is actually causing this EBIT weakness. So now we look at EBIT per segment. So the auto segment and the credit segment first of all. So the credit segment is up 83% in the first half to 1.2 billion. But the auto business is down 57% in the first half to 2.2 billion. Because credit is performing so well, it, despite the much smaller size, did in fact create a meaningful offset to the weakness in auto. And therefore the total headline EBIT number for the entire company does in fact hide, at least to some degree, the exceptional weakness in earnings generation in the auto segment. You can see it up here. So first quarter EBIT was a complete disaster. EBIT was down 78% year over year. And then in the second quarter, despite the recovery, which I believe is slightly positively boosted by some unwind effects as explained, is still down 36% year over year. And you can see when you go back to kind of better years, the auto business always struggled with performance. But now let's talk about the auto segments which are causing this weakness. So now you're looking at the EBIT breakdown in the auto segment into the three main buckets, so Blue, Pro, and Model E. And you can see, at least for the first half, you can see weakness across the board. So the consumer segment, Blue, is down 63%, generated only 0.8 billion in EBIT. The Pro segment down 35%, generated 3.6 billion in profit. So you can already see, as we established earlier, in terms of revenue, the Blue segment is substantially larger than the Pro segment. Call it roughly 40% larger. But in the first half, the Pro segment generated more than 4 times the EBIT of the Blue segment. This already shows you there's some huge discrepancy between the customers in the Blue segment and the Pro segment, and I argue can only explain this by having buyers that are not price sensitive. Corruption cough. Sorry, we move on from there. And then you have the Model E. Model E, the EV segment, so this is EBIT, is a complete disaster. When you look at this trend, so the loss in the second quarter has increased 16%. The loss in the first half or year over year is down 12%, but it's still a loss of 2.2 billion. In the full year of 2024, the EV segment lost 5.1 billion. That's more than what they lost in 2023, 4.7 billion. So losses actually increased. Basically had an increasing trend. Only in the last few quarters it's coming down a little bit, but it's way too slow. And latest sales trends suggest these losses basically will continue. So therefore, next week's EV unveil will be very interesting. I think if Ford can't show something that is really, really a home run, I think the stock will sell off. But again, it depends on how the stock trades before. If the typical, or what you often see, buy the rumor, sell the news type of trading, so we see some strengths into the event. If they don't hit the home run, of course there would be likely more significant sell down. But if the market goes into this event with low expectations, the blow might be not that material. And again, I don't expect this company to produce something that will blow everyone away. But should the stock experience some hype, which could happen, I think it's unlikely. Based on I think what we discussed here and what you will see later, one might want to think about short, not trading advice, make your own decisions. But again, it depends on how the stock reacts. But let's look at margins now. So we have a relative metric. So the EBIT margin, so this is earnings before interest and tax divided by respective revenue. Respective revenue means you take, for example, in the Blue segment, the EBIT that was generated in the Blue segment and divided by, of course, the revenue that was generated in the Blue segment. And when you look at this margin, I think it becomes even clearer that what I speculated before, that something is going on with these customers in the Blue and the Pro segment that is not quite driven by market forces, let's say. You can see in the Blue segment, it's on the consumer segment, Ford makes barely any profit. First half margin was 1.6. It recovered, as we discussed in the second quarter, moved up to 2.6%, which is still super low. And even during the best of times, so first quarter of 2023, for example, was only just slightly above 10%. But then when we look at the Pro segment was for a long time above 10% and had some really outlier quarters at 15.3%. margin in the second quarter of 2023, almost 17% in first quarter of 2024. And when you can see there's a bit of seasonality in this sales. The first half here saw some very strong margins, and then towards the second half of the year it tapered off a bit. But this is too little data to draw conclusions, I believe. But these very high margins have been coming down. And in the first half of this year, so the pro segment came down to 10.7%. And when you look at the full year margin of 2024, 13.5%, that is a substantial decrease. And especially when you compare the first half of 2024 with the current first half, margin came down 5.2 percent points. And that is actually the primary driver of the EBIT loss in the company. So now after all this the debate and all these many slides, we nailed it down. So the material decrease in performance in the pro segment is the primary driver. I'm purely speculating by saying the next thing. Maybe we see some slight effects of Doge or something, because again, this is, I believe, significantly government-driven, this high margin. I don't know, but we could see some knock-on effects because this margin erosion is quite material. And then the EV segment, I mean, the numbers speak for themselves, complete disaster. The second quarter was negative 56%. The first half is at just under negative 61%. The full year last year came in at negative 51%, after the margin was negative 39% in 2023. So really outrageously bad numbers. I believe management, when they started disclosing the EV segment, made a huge mistake, huge miscalculation. And when you look at these numbers, they actually started off with lower losses. And my hypothesis is that when they launched or when they developed the F-150 Lightning and the Mark E, I think what I thought is, okay, we have a very large market in the United States, very large market share in pickup trucks. If we can only generate a fraction of the F-150 success in the EV segment with the Lightning, we're going to have a product that will be fine. And will impress investors how quickly we can grow EV market share. Also, the SUV segment, in which especially the class of SUV, the Mark E, would be attributed to, is a huge segment in the United States. And I think Ford made similar assumptions and thought, okay, we launch two products in the two most popular segments in the United States in our huge home market. And as long as we only achieve a fraction of the success that we have in our ICE, so internal combustion engine lineup, numbers will be all right. That was a huge miscalculation, and I think if management could go back in time, they would certainly not break out the EV segment, because nobody forced them to. There was not a shareholder vote or something, or shareholder asking for this disclosure. I mean, certainly some shareholders somewhere would have asked for that, because there are probably hundreds of thousands of shareholders. But the bottom line is that there was no significant voting power pressuring management to make this disclosure change. So this was a huge miscalculation. And that shows, I know a lot of people like Jim Farley, the CEO. When he goes on interviews, he's a very likable person, but just purely from financial performance, analytical perspective, he has been an awful CEO. This is awful performance that we've seen under his reign. And this disclosure change, even though to a lot of people who are listening to this may sound like a little irrelevant aspect, but by these small but clear misjudgments, you can, at least to some degree, assess the quality of the management, because strong management does not make such mistakes. These are rookie mistakes and are clearly based on poor assessment of the market. In general, I would advise investors pay extreme attention to these small things. For example, if a company delays publication of results, it's a huge red flag, even if just by 1 week. And another huge red flag is if there are meaningful restatements of numbers. Unless, of course, there was an accounting change in rule, but it was just a restatement. This is also indicative of bad management. And for really the hardcore nerds who read financial statements, if you see typos or some small inconsistencies, it's also red flags, because it just talks to the quality of the people who work on this stuff. And high caliber management does not tolerate underperformers around them. Again, these are small breadcrumbs, and they may not mean anything, but in some cases they can lead you to the right path. But these breadcrumbs can come in all shapes and forms. For example, in Fisker, the bankrupt EV company, a huge red flag was obviously that Henrik Fisker already had at least one bankruptcy under his belt before he started Fisker. And number two, he made his wife CFO, who had, when you looked at her resume, absolutely no business running, being the CFO of an automaker. Track record of management does matter enormously. So as much time as you spend on financials and valuation multiples, at least as much time you should spend on management. But the problem is this is not something you can easily pull up on a Bloomberg terminal. This requires some work. Before I start rambling too much, let's move on. Now we look at operating profit. Here on the right-hand side, you see the key drivers. So you take total revenue, you remove all the cost of sales, you take off your operating expenses, and the leftover, the residual, is operating profit or operating loss. In Ford's case, the last time they generated an operating loss was in the fourth quarter of 2023. But this is now ancient history by today's vantage point. So what happened in the second quarter? Quite disaster. Operating profit was down 73% year over year. And the first half is also down 73% year over year. And they generated only 0.8 billion in the first half and 0.5 billion in the second quarter. As a result, the operating margin, so if you take operating profit divided by total revenue, came in super low. Second quarter margin at only 1.0%. That came down 2.9 percent points from last year's second quarter, where the margin was 3.9. These are all super low margins. 1% operating margin is nothing. Basically, anything below 6% requires management significant justification on how they plan on turning it around. 6% is still not good or acceptable. So when you look at Ford's operating margin, this has been a long-term big problem. Only in the very best of times, for example, in Q2 2022, they achieved a 7.1 operating margin. And then in subsequent quarters, it was quite, let's call it hit and miss on a low level. So this I think the plot, the more we go into the numbers, I think the more and more the plot thickens why this company is trading at such low multiples, because there's just a very long track record of really terrible performance. But next, let's look at non-operating items. So the key buckets in non-operating items are the interest expense on debt used in the auto segment. This does not include the interest expense on the debt that is used in the credit segment. We will spend later a lot of time on this point, because this is commonly confused by people who are looking at Ford's financial. They look at the almost 160 billion in Ford debt and think this is all Ford company debt, but that's the wrong way of looking at that, and I will explain later why. So this auto interest expense is not the interest expense on this total almost 160 billion in Ford case. No, this is only on the debt used in the auto segment, and that's a small fraction. It's only around, I think from memory, 20 billion. And Ford pays on that roughly 20 billion per quarter, just under 300 million in interest expense. This number is driven by the level of interest rates that the Fed sets, and you can see this in these numbers. The debt level stayed relatively constant, but you can see how the interest expense came down. This is in part due to lower interest rates in the market. The other factor affecting interest expense is Ford's credit rating. We'll discuss this also later. And then third, spread, but this is not something I'm going to dive into in this presentation because it's its own topic. So the second bucket is other, and other income and losses. So this item comprises various other things. For example, the income or loss Ford books on its large pension liabilities. There's some interest income or expense it books on some income taxes. It also includes some realized or unrealized gains, losses on cash equivalents, marketable securities, and any kind of other investment. But also importantly, any gains or losses in the value of certain investments in affiliates. An affiliate is a company where Ford has a stake, but a stake that doesn't give it control. Once you hit the control threshold, it becomes a subsidiary, and in most cases you would consolidate that company. So, but other also includes royalty income that Ford generates. In this presentation, so it doesn't get too long, we can't discuss all these items in detail, but I just want to point out in the most recent quarters, the primary driver was investment-related income that Ford reports in that item, and you can see the total bucket was a positive 577 million. And the reason why this is worth me paying attention to it is because the overall earnings of the company has become so small that this item now becomes a major driver. But before we dive deeper into this other item, let's just briefly touch on the third bucket within total non-operating items. This is equity income or loss. And you can see there have also been huge changes. For example, in the third quarter of 2022, Ford booked a 2.6 billion equity loss. That was in relation to the impairment of Ford's Argo AI investment. But in other, you can see on this chart, there was a huge negative blow in the first quarter of 2022, almost 5 billion. This was driven by Ford's write-off or significant write-off of its investment in Rivian. Rivian, when it IPO'd, was vastly overvalued, hitting over 100 billion in market cap. Ford wrote the asset up, realized significant one-time gains, but then Rivian came crashing down, and then Ford was forced to write it off, or not write it off, write it down. So next, let's look at investment-related income. Again, this sits within the other income loss bucket within non-operating items. So now we are really double-clicking quite often into financial items. And you can see this item has been growing quite a bit. And again, this is related to interest income Ford generates on the cash balance it holds. And the cash balance should be viewed as not only cash and cash equivalents, but also any kind of short-term investment. And Ford generated 368 million in the second quarter just on interest income on all these cash holdings, and 719 million in the first half. And the reason why this matters in Ford's case, you see on this chart. This chart expresses this investment-related income as a percent of total profit before tax. And you can see that at least over the last, let's call it 6-7 quarters, there has been a massive upward trend. And in the second quarter of this year, 68% of profit before tax came from investment-related income. I repeat, 68% came from interest earned on the cash held, and a lot of it is held in the form of government bonds. I posted the other day on X and asked if the majority of Ford's earnings come from investment-related income, why would you buy this risky stock over a government bond? Makes absolutely zero sense. But let's not get ahead of ourselves. Let's keep going. This chart shows you profit before tax. Again, abysmal numbers. Profit before tax down 78% year over year to 0.54, so 540 million. The first half is down 71% to 1.2 billion. You can see over the long term profitability in terms of profit before tax has always been quite abysmal. This is the profit before tax margin, also super low. Second quarter 1.1%. First half sits at only 1.3%. Last year it was only 3.9%. So they're really catastrophic numbers. Next we move at profit after tax. And now we can see that the company was even loss making. And profit after tax is often also called by investors, bankers, etc. bottom line. So the bottom line is negative. Ford generated a small loss, a $29 million in loss. And the first half comes in at a profit of 444 million, but is down 86% year over year. So what is causing this loss? And boom, this is what you see on this next chart. You see the profit after tax in the automotive business. And you don't get this for all the automakers, but Ford is amongst them. And Ford actually discloses the profit after tax just for the auto segment. This is what you see on this chart. The auto business lost in the second quarter 572 million, generated a marginal profit in this first quarter 49 million. So despite all the recovery we talked about in the beginning of this presentation in terms of revenue, as first quarter headwinds turned into some tailwinds, etc. All this stuff amounted to absolutely nothing, as you can see in this loss in the second quarter. So what really, really helped Ford out was the credit segment. But as we discussed earlier, the credit segment can only grow for so long before it has to catch up with the auto business. Next, we need to talk about adjusted shareholders' net income, because that is the primary metric we have to use for valuation purposes, because this is the metric that strips out all the one-time items. And valuation you always want to do on what's called a normalized basis. A normalized basis means you take out everything that is not considered into perpetuity, because that's the basis of valuation, multiples valuation. Any metric you apply a multiple to must be on a clean number that takes out all the one-offs. And in Ford's case, the best number we have is adjusted shareholders net income. And some key adjustments that are made to get from the GAAP number shareholders net income to the non-GAAP number adjusted shareholders net income is that you need to adjust for pension gains and losses. I will not discuss what that is because that would take too long. It has to do with actuarial gains and losses. I happen to be an expert in that field, but it's overkill for probably 99% of people who listen to this right now. The next item we need to adjust with gains or losses in equity securities, add back restructuring charges, and anything other that management deems not ongoing in nature. So for these adjustments, due to a limited disclosure, we have to rely on management, what management deems non-recurring. So this adjusted shareholders net income is what Ford reports, and this is what you see in front of you. But I'd like to point out that often between the reported GAAP number and the adjusted number, there's often a huge discrepancy. But Ford is not alone. General Motors is in the same boat. They have also consistently huge gaps between adjusted and non-adjusted earnings. But anyways, with that out of the way, let's look at the numbers. So adjusted shareholders net income is also down 22% in the second quarter. First half is down 47%. So a huge performance drop. To make this metric more useful, we need to turn it into an adjusted earnings per share number on a diluted basis. This is what this chart does. So it takes what you just looked at, the adjusted earnings, and divides by the applicable diluted number of shares outstanding. The overall picture is similar. Second quarter EPS came down almost 22%. Ford reported adjusted earnings per share at 37 cents per share. The first half is down 47% and earnings came in at 51 cents per share. And here on the right hand side, you can see the trailing 12 months calculation. Trailing 12 months came in at $1.39 per share. But before we move on to valuation, I want to cover cash flow because cash flow and related items, cash balance, leverage, these things are much more important than just the earnings now we are looking at. So on this chart, you look at the operating cash flow generated in the auto segment. And here's one important point. Because Ford's financing arm credit is so large, and because it's a financial services type business, it creates such enormous cash flow volatility. You should not and you cannot analyze an automaker's cash flow. If you look at the total group cash flow, you always need to outstrip a large financing business. Otherwise, you run risk of drawing completely wrong conclusions. I will not go into detail why that is. That would take too long because I would need to dive into the differences between like a normal type of business and a financial services type of business. And that would again be its own video in itself. So for now, you just need to take my word. So now let's look at the numbers. So Ford brought in operating cash flow of $3.8 billion in the auto segment. That on the surface looks like a decent number, but it's down 21% compared to the second quarter of last year. The first half is down 33% and it brought in only $3.4 billion after in the first quarter Ford actually generated a negative cash flow of $430 million. Before we move on, here on the right hand side you see the breakdown of the cash flow statement and you can see the key drivers. So you see net income, depreciation, amortization, credit loss provisions, etc., etc. You add everything up and you get to operating cash flow. And just real quick, the way it works is you start from net income that you see in the income statement, and then you add back amounts that have been reflected for accounting purposes in net income, but which did not cause a cash in or outflow. So for example, depreciation is reflected in net income. It's a charge. It reduces your net income. But because it's a non-cash item, you want to add it back into net income. And that's why it's always a positive in the cash flow perspective. The same with amortization. Amortization causes your net income to be reported lower. But this is only for accounting purposes. But we are interested in a pure cash perspective. And that's why you also need to add back amortization. And then basically the same thing happens with all the other items, although they're a bit different in nature. For example, receivables is something where people owe something to Ford. So Ford did something where Ford paid for something. And if people did not pay for that, it causes actually a negative impact on Ford's cash flow until these people pay. When these people pay, receivables go down and then you have a positive cash flow effect at Ford ends. So just real quick how cash flow statement works. Again, at university, this would usually be taught in, 1, 2, 3 hours of lecture. And I try to compress this down into 10 seconds, so please bear with me. So let's look at what this actually looks like in terms of numbers. And this is what this chart does. This looks quite overwhelming at first, but it's actually not that bad. Here at the top, you can see the totals. For example, here 3.8 is in billion. 3.8 billion is the total cash flow. If we jump quick back, so this is this number here, 3.8 billion. And what you see is all the components that add up to the 3.8 billion. So there is, for example, in the second quarter, there was 1 billion positive other. There was positive 4.2 billion from payables increase. So the amount Ford owes other companies went up. This is positive for cash flow because it didn't pay. And then inventory cost a 1.2 billion positive. So Ford reduced the inventory. Then there was a 1.3 billion add back from depreciation charges we discussed earlier. Then there was a negative, there was a cash outflow of 0.6 billion from net income. That's the loss. So this, I mean, the exact number is 0.57 billion. That is this number right here we discussed earlier. So the automotive profit after tax was 572 million negative. That is exactly this number that you see down here in this blue box. And then the last item that cost always cause a negative cash effect is interest supplements and what's called the residual support for Ford's credit segment. But this is also an item where I have to dive into securitization and other things to explain it. So I will skip that. But I really give you the really high level download on this item. And this is Ford's auto segment transfers money to the credit segment. So the credit segment can enhance the securities it issues to finance itself. So let's look at what we can actually see in these numbers. So let's start from the top. So we saw there was 3.8 billion in positive cash flow. So it looks very good at first glance. But what actually was driving it? So first of all, there was this 4.2 billion, by far the biggest bucket, and there was payables. So payables is bills Ford did not pay yet on things from which it generated revenue. Let's say I sell bread. You're the supplier. You give me that bread. It costs me, say, $2. I sell that bread for $4. I get paid immediately by the customer. I book the $4 as cash inflow, but there's the cost of $2. So the cash inflow would only be if I paid you also immediately, just as the customer did me. I would only book a $2 cash inflow. But I'm deciding I'm not paying you this quarter. So because I have now a liability towards you, I book this in my balance sheet and I increase my liability called payables by $2 to you. And that increase in the payables is cash flow positive, because now I'm not only booking the $4 in revenue minus the $2 in cost. That's reflected in my net income, because I'm now doing a cash flow perspective. I'm adding back the cost that I owe you, that I deducted for accounting purposes for my net income. I'm adding back in the cash flow perspective, and that's why I have this big add back here. So this 4.2 billion is basically the $2 that I'm not paying you in Ford's case. I hope that's clear. Again, I'm covering here some accounting basics, so I apologize for all the experienced investors who know all this stuff, but I think it's just important to cover this so that also other people can benefit from these types of videos. So another thing, first observation is, so the cash flow was predominantly driven by a low quality item increase in payables. And the reason to think about what is high quality and low quality cash flow item is think about it into perpetuity. Can Ford forever increase payables? The answer is kind of, if the business is growing, because relative to its size of its business, it can keep growing its payable balance. That's possible, and you can demonstrate this if you do like a long-term historical analysis of various companies. But we established Ford is actually shrinking. So Ford is absolutely not a growth business. So this item is not sustainable. So the biggest driver is a low quality item. So let's keep going through these items. So the second largest item in terms of positive impact was this black box. As you can see, this was 1.2 billion. This is inventory. So Ford reduced inventory. Inventory, again, apply the same mental model. Can this cause a positive increase into perpetuity? No, absolutely not. Because it's only positive as you reduce. And once you hit zero inventory, you cannot reduce it further, and this item drops to zero. Again, low quality item. And sorry, I got the order wrong. The second most important item was actually depreciation. It's 1.3 billion. Inventory had a 1.2 billion impact, but small point. So let's talk about depreciation. This one we can cover very quickly. This item, as you can see, is fairly consistent, and I would consider high quality because number one, it's high consistency, as you can see in this chart. Number two, if you apply the mental model again into perpetuity to keep the business going, the company constantly has to reinvest in capex, etc. Constantly creates a depreciation, etc. And it's reflected in net income. So this is fine for me. This is, my view, high quality item. There are some issues with that, but just from a pure cash flow perspective, it's fine. But again, by its consistency, you can see this is not a major driver to the upside, but also not downside, so it's neutral in my view. Then we have 1 billion in other items, and there we have all kinds of different things, and here on the right hand side I put down a couple. There's a credit loss provision, pension expenses or income, equity investee loss or gain, foreign currency adjustments, stock compensation, deferred income tax, and other. So it's a whole bunch of things. So let's look over time how this item moved. And in some quarters it was a complete non-needle mover, like in the second quarter of 2024, or in the first quarter it was completely absent effectively. So it was in the fourth quarter of 2024, no material impact, a tiny bit you can see here. There was a huge impact in the first quarter of 2022. But again, this is quite a mixed box. It's quite volatile, and due to its volatile and inconsistent nature, it's not a high quality item. And the other important thing is this is significantly driven by net income adjustments, because when you look closely, when it's super large, because it's a non-cash item. For example, we talked about the Rivian write-off. This is a non-cash negative in Ford's income statement. So it's a huge negative in terms of net income. That's why you have this almost 4 billion in loss in the first quarter of 2022. And that's why then this item is like the mirror image, spikes up. That's why I would recommend these two items, so other and net income, to think of it like as one. That provides a much clearer cash flow perspective. So if we do that, so you have 1 billion positive, negative, call it 600 million. So we have 0.4 billion operating cash flow that is of quality, plus the depreciation cash flow from the unwind of the accounting charge. It's another 1.3 billion, so we are at 1.7 billion that I would consider quality cash flow. But then we need to take a deduction from the Ford credit, let's call it enhancement, the transfer that I just explained that the auto segment has to make to the credit segment. This is it's always negative, and it has some consistency and it's growing. So from the 0.7 billion that we added up, we should probably deduct the 800 million at least. So we're now back down to 900 million in free cash flow. That is of quality nature. But lastly, we have to discuss about receivables. There was a huge negative impact. Receivables is the opposite of payables. So if customers don't pay Ford records an increase in an asset. That asset is called receivables. So something it's supposed to receive from other parties. That, in theory, could also grow into perpetuity as the business grows. But again, the business is not growing. Therefore, I'm inclined to view this item as more neutral. So this was a rather long discussion of automotive cash flow. And the bottom line is that in reality, cash flow was probably closer to just under 1 billion than the 3.8 billion. So then when we run the same exercise for the first quarter, and I will do this now super quickly, we just add up depreciation charge. There was no net income effectively. We take off the Ford credit enhancement, and the residual is only positive about 300 million. So the bad first quarter, 300 million free cash flow roughly of quality, and in the second quarter only roughly 900 million. So that gets us to quality cash flow of only 1.2 billion in the first half. It's really not a lot, and we get to in a second why. And here is why. This is capital expenditures in the auto business, and this is almost 100% of the company, because in the credit segment there's almost no capex. So capex, capital expenditures, it's the same thing, comprises all investments in factories, tooling, equipment, machinery, etc., etc. So anything Ford needs to sustain the business, to make the product, except R&D, this is booked in the P&L. Capex only shows up in the P&L in the form of a depreciation charge, while the full impact of the spend is reflected in the cash flow statement. And you can see in the second quarter of this year, Ford spent just over 2.1 billion in capital expenditures, 1.8 billion in the first quarter. So this year, Ford already spent 3.8 billion. This is down 7.4% year over year. I'm not surprised by that. I mean, the business is shrinking. And you can see by the quarterly year-on-year rates, second quarter is down 1% year over year, and the first quarter was down 14% year over year. So now what you should do is you should compare these, for example, this 3.8 billion in capex with the quality cash flow that we just calculated of about 1.2 billion in the first half. And you can now see that there's a huge capital gap. So quality cash flow only added 1.2 billion, but they spent 3.8 billion. So that's a big problem. And this is a key reason, in addition to all the other reasons we already discussed, why the stock is trading at such a low multiple. Next, we look at the free cash flow. So the free cash flow just takes the reported operating cash flow. So for the second quarter, as you remember, was 3.8 billion. We deduct the capex, which was 2.1 billion, and the residual shows you, as shown on this chart. This shows you reported auto free cash flow of just under 1.8 billion. But as we already established, most of it was driven by low quality items. And when you look at this chart, the first quarter was deeply cash flow negative at 2.2 billion. And even without adjusting for quality and low quality items, the first half, just on a reported basis, was negative $500 million. So Ford has massive cash flow problems. And when you go back one quarter more to the fourth quarter of last year, free cash flow on a reported basis was only just over 100 million. So the key takeaway from all of this is relative to its free cash flow generation, Ford's business model requires way too much capex to keep it going. So in other words, Ford is currently in an absolutely unsustainable situation. If we go back to the bread example, if you keep selling bread for $4, but constantly investing in new ovens, etc., tools to make the bread, it costs you on average per bread $6. This is not going to work out for very long. So next we need to look at cash balance. And cash balance, a quick recap, comprises not only cash and cash equivalents, but also always include short-term investments, because if Ford needed more cash or cash equivalents, it could simply sell short-term investments. These are highly liquid investments like short-dated government bonds, for which there's a huge global liquid market, and that's why they're quasi-cash equivalents. To not include them into cash balance is a rookie mistake. So on this basis, let's look at the numbers. So the cash balance, and again, the cash balance you're looking at is just for the auto business. Because again, it's very important to differentiate the auto business and the credits business. So the auto business has 28.3 billion in cash as of June. That's the latest balance sheet date that is available publicly. You can see over the last couple of years, cash balance was held relatively constant around the, let's call it 28, 29 billion mark, with only one notable outlier that was at the end of the first quarter of 2024, where cash balance dropped for the first time in a long time below 26 billion. But whenever you look at cash balance, you need to look at debt balance, because it's too easy to boost cash balance by increasing debt. Because if Ford issues some corporate debt, let's say they issue 1 billion in corporate debt, and don't spend it immediately, that 1 billion in debt shows up in cash. It increases cash by 1 billion. Just like, let's say you take out a loan, you get a loan account, the amount of the loan is shown in, let's say you take out a $10,000 loan, you get a $10,000 loan account. That's your debt balance, but the bank will transfer that money into your checking account that shows your cash balance, and your cash goes up by the loan amount. Of course, that's the case if the cash lands in your account and not the bank immediately paying for whatever you are using the loan for. So, and for that reason, because that can boost cash balance, we need to look at what's called financing cash flow. So this chart shows you financing cash flow for the, again, pure auto business, not the credit business. And surprise, surprise, financing cash flow was negative 1.4 billion. So negative financing cash flow means that on a net basis, if you sum up all the capital Ford raised from both equity and debt providers, and all the equity and debt it paid back, if Ford returned more capital than it raised, the financing cash flow is negative. So Ford did actually not boost its cash balance by increasing debt. And it also didn't raise any equity. And we can see what happened in this chart, because this chart is the same chart as the prior chart that shows you the negative financing cash flow. Again, here the total is 1.4 billion. I just jump back real quick so you see. So this is the 1.4 billion in the first quarter, 1.2 billion negative. These are the numbers up here, these are the totals, and here you see the components. What amounts make up these negative financing cash flow? So the number one is the first item is what keeps Ford's stock price still where it is and not from dropping further, and that's the dividend. Ford is a dividend paying stock, and Ford paid in the second quarter 600 million dividend. Then the second item is that Ford paid down some of the long-term debt, almost 900 million. There are a bunch of other items, but they're all not needle movers. So in most quarters, Ford's financing cash flow is negative, and it's mostly driven by dividends. And that's the primary reason why the stock is not dropping more. So now put everything we just learned together. Number one, there was significant 3.8 billion of reported operating cash flow, but only about 900 million was quality cash flow. The company spent slightly over 2 billion on capex. So the quality cash flow was not enough to pay for that. So it kind of lost 1.1 billion. It weakened its underlying capital position by 1.1 billion. Ford did not raise any equity. It did not raise any debt. It did the opposite. It paid out some equity in the form of a dividend, and it reduced the amount of debt it's using. But still, the cash balance increased. And by analyzing the operating cash flow previously, by looking at the large increase in payables and some other items, we know that the increase in cash was driven by low quality items. So the second quarter situation cannot be sustained for several more quarters. Paying dividends, reducing debt, paying for high capex, while operating profitability is very low. So something has to give. The thing Ford will touch last will be the dividend, because the dividend is what sustains Ford's share price, because obviously there's no growth investor in Ford. So I would be shocked if not at least 90% of Ford's investor base wasn't dividend investors. And next we need to look at debt levels. On this chart you see total debt, so not only the auto business but also the credit business. And as I pointed out earlier in this presentation, most of the debt sits in the credit business. And to be precise, of the total of 158 billion in total debt on Ford's balance sheet, 87% of which sits in the credits business. Debt increased year over year 7 billion. In contrast, the auto business, which is Ford excluding credit, only sits on 20.3 billion in debt. That's actually slightly down year over year, roughly 100 million. And that only contributes to the total debt pile 13%. But as I pointed out several times now, you have to look at Ford's business excluding credit when it comes to debt and certain other things. And this is what this chart does. So this chart expresses the debt in Ford's auto business in terms of leverage ratio. And the leverage ratio I'm using here is one of the stricter ones, because the way it's calculated, it takes all the debt in the auto business divided by capital. And capital is defined as the sum of total equity in the auto business plus all the debt in the auto business minus any intangibles. Ford has almost no intangibles, so it's not a factor in Ford. And the chart shows you here the trend of this ratio, and Ford always maintains a fairly stable leverage ratio. It's always just above 30 or 31%. That is not very high leverage. That would be considered moderately or slightly above moderate level. But credit strength is not only assessed by a leverage ratio, there are various other things. I can't get into all these items because a credit analysis is like it's a whole separate thing. So let's do a shortcut and let's look at what the rating agencies say. So the big three ones are Moody's, S&P 500, not S&P 500, sorry, S&P Global Ratings and Fitch. S&P is arguably the number one player, second Moody's, and third Fitch. I think this is typically how most investors would look at these rating agencies, which lost a huge amount of credibility during the great financial crisis, where they rated a lot of stuff very highly, and afterwards it turned out it was all trash. But it's a different story. So let's discuss what they say about Ford. So Moody's says BA1, S&P triple B minus, Fitch says also triple B minus. Outlook, Moody's stable, S&P negative, Fitch also stable. Latest rating updates, Moody's as of May, so quite recent. S&P as of February, also still relatively recent by rating agency standards. Fitch as of December, also okay. Typically you get 1 to 2 updates a year. I mean real updates, except something extraordinary happens. So let's zoom a bit into this rating scale. So what do these rating levels mean? So for Moody's, the BA1 means it falls into the non-investment grades or speculative bucket. So it's high risk security. So if you, and this is the rating on Ford, the car company, and not on the securities issued by the credit segment. It's a different story. So the debt of the car company Ford is rated very lowly by Moody's. And we get to in a second why they think so. But I think after all this presentation, I think you already know quite well why. S&P has a slightly better view of Ford, triple B minus, which puts it into low medium grade. So just above junk, basically. So junk is when you fall into this B range, or non-investment grade. And then also Fitch has a similar view to S&P. It's also at the low end of low medium grade, also just above junk. So if you read the reports, they basically kind of say all the same thing. I wrote here a little synopsis. So basically it comes down to Ford has various internal challenges with profitability across various segments, as we already looked at. The transition to electric vehicles appears to be still not under control, as reflected by still extremely high ongoing losses in that segment. In various markets globally, Ford is losing left and right market share. This trend has been also ongoing for a long time. At this point, Ford has become a basically irrelevant player in all markets except North America. Ford doesn't disclose it, but I would be shocked if Europe would be more than break even. But then also these ratings agencies note that, for example, as you can see also on its leverage ratio, Ford has a still adequately strong capital base, and that limits downside for, and this is a very important point, for debt providers. And in a bankruptcy, debt providers get paid before equity holders, i.e. shareholders. And that's why debt providers can feast on the assets of Ford in a bankruptcy case, and that's why rating agencies that only talk from a debt investor perspective point these things out. So I stop this video here. In the next video, I will be discussing valuation. This includes earnings outlook, observable trading ranges based on forward multiples, implied price target for Ford, and the trading range, so share price corridor, that is inferred from these data points. And I will close with discussing Ford's share price volatility and how an investor could take advantage of share price movements. So this was part 1. Thanks for listening and hope to see you in part 2. Bye.